Buying a home is most likely the biggest purchase you will ever make in a lifetime. So if you already own your home or are in the market to purchase one, having to pay down your mortgage for 30 years may seem like a daunting task. So how about this? How would you like to be mortgage-free in 5 to 7 years? Mortgage Equity Acceleration gives you the strategy to pay your mortgage off years sooner than you might think possible with the same level of income and expenses that you now have. Jordan Goodman is a personal finance expert and author of Master Your Debt, Slash Your Monthly Payments and Become Debt-Free. He joins me now with tips on how to pay down your mortgage in just a few years. Hi there, Jordan. Great to see you.
Great to be with you, Tanya.
All right, Jordan, let's start with the first thing you say one should do. You say finance a new home or refinance an existing one by obtaining a home equity line of credit requiring an interest-only monthly payment for at least 10 years.
That's correct.
Now, I have a couple questions about this.
Sure.
First of all, it must be really hard to get this right now in this climate. And aren't these the kind of mortgages that got us into all this trouble?
Not really. The people that got us into trouble with the subprime mortgages, and this is not subprime at all. A home equity line of credit, or a HELOC, is basically like a checking account backed by your home. You can put money into it, you can take money out of it whenever you like. And they're not really that hard to get. A lot of banks offer HELOCs today. This is a very different animal than the subprime mortgages that got people into trouble. So no, you can actually get it quite easily.
All right. Okay. So the next step then, use this HELOC, this home equity loan of credit, to pay off your existing mortgage. So this line of credit replaces a new or existing conventional mortgage. So you're just replacing one loan for another, right? What's the benefit?
Well, possibly, if you can. I mean, if you have a big primary mortgage, you might not be able to get enough of a HELOC to pay it off completely, but then you keep your primary mortgage and you have the HELOC as a second, kind of feeding into paying off the first. If your existing home mortgage is $200,000 or $300,000, you might be able to get a HELOC for that amount and be able to pay it off. But if you've got a $700,000 or $1 million mortgage of some kind, then you're not going to get a HELOC big enough to do that. But basically, the idea is to feed the primary with the HELOC.
So this plan doesn't really work for people that have big mortgages.
Well, it does work. It's just you have to have both. You can't have a HELOC be your only mortgage. Right. Ideally, if you've got a $200,000 or $300,000 mortgage, you could get a HELOC for that full amount and only have your HELOC.
All right. So after you pay off your existing mortgage with this HELOC, the next step, you say, is to send your whole paycheck into the HELOC every time you are paid.
Correct.
Now, so what do you live off of?
You're paying your bills out of the HELOC as well, but your income is pushing down your principal every day by keeping it in that HELOC. See, what most people do, Tanya, is they put their paycheck in a checking account on which they earn zero, right? So it's not getting any interest whatsoever. But here, every day that goes by that you have your income in that HELOC, you're pushing down that principal a little bit. So the way I think of it is, instead of not earning interest on the checking account, you're not paying interest on the HELOC. It's based on what's called average daily balance. So how much do you owe today?
You're basically just canceling out the interest.
Correct.
Okay, so
you're paying down the principal and therefore paying less interest. That's correct.
But, okay, so let's say, though, you live pretty much hand to mouth like so many Americans. Your paycheck comes in and it goes right out to all of your expenses. So it's not really sitting in your HELOC very long. Are you really getting any benefit from that?
You are getting benefit because every day that goes by, that you're pushing down your principal a little bit, as opposed to having it sit in a checking account earning nothing. So the more positive cash flow you can have, the faster you're going to pay off the mortgage.
All right. So what do you do with any extra money, let's say, you do have left in the HELOC account after you pay off all your bills?
Well, you want to keep it in that HELOC as long as possible because, again, every dollar that you have in the HELOC, every day that goes by, you're paying off the principal a little bit more. They take a look at the end of each day and say, how much do I owe? How much interest is based on that? So every dollar that you've got sitting around doing nothing, you get in that HELOC. It really makes a big difference. Every month you pay off more and more principal. That's why they call it acceleration.
Sounds great. So do you have any examples of how much money you can save in the long run?
Absolutely. There's some big numbers here. All right, so let's give you some examples. The first one would be a 15-year mortgage. Doing a traditional 15-year mortgage on a $225,000 loan, you would have roughly $100,000 in interest on that. That's a traditional one. And then the exact same thing, everything else being the same except you're using this mortgage acceleration, you're going to pay about $22,000 in interest.
Huge
So you save
savings.
10 years and almost $80,000 in interest on a 15-year loan.
Absolutely. This is big. So what about a 30-year? How much can you save with a 30-year?
Even bigger, even bigger. So in a 30-year loan, I think in this case we have a $400,000 mortgage with a traditional 30-year traditional fixed. You're going to have about $486,000 in interest over those 30 years. And if you do the mortgage acceleration, you're going to pay $100,000 or $102,000, very small amount like that, over 9 years typically. So you're saving $386,000 and over 20 years off your mortgage.
So Jordan, why isn't everybody doing this? There must be a catch. This can't be for everyone.
Well, people don't know about it in many cases. The banks don't particularly want you to know that you can pay your mortgage off in 5 to 7 years instead of 30 years, so they're not exactly advertising this kind of thing. But there are some things that you do need to make this work for you, and it's not for everybody, you're right. So the first thing you need is positive cash flow. Now, you've got to have you need positive home equity, meaning you've got to have equity in your house. You have to have positive cash flow, meaning more money coming in than your expenses. That's what's pushing down the principal. And you've got to have a credit score, maybe 680 or higher, if you don't already have a HELOC, to be able to qualify for something like that.
Right.
But if you have those three, you can absolutely do the strategy.
All right, so do you have any tips on how to do this right so that you really take advantage of it?
Absolutely. The first thing you want to do is get the right loan. You want to have one that's completely liquid, that's going to go in and out, that you don't want to get frozen in this kind of thing. You also want to, if you possibly can, set up easy transfers, because the money's going back and forth between the HELOC and the checking account on a regular basis. And then you want to get as much money in there as possible and make that thing really move down very fast. It's the primary depository for your income. And there's a website you can find out about all of this, which is truthinequity.com. And at truthinequity.com, they have a little personal profile that you actually fill out, put in the numbers that apply to your situation, and the end result is, okay, in your case, Tanya, 6.2 years or whatever the number comes out to be, and then they help you actually execute the whole strategy.
Wow, that's all. Sounds great. If you can do it, why not? All
Absolutely.
right, Jordan, thank you very much. I'm once again joined by Jordan Goodman, author of Master Your Debt. In this segment, Jordan's going to help answer some viewer questions from our Good Money mailbag. All right, Jordan, you ready?
You bet.
First question comes from David of Boston, Massachusetts. He writes in asking, what would you recommend for someone whose home value is less than the mortgage principal but is able to make payments? Is there a money-saving strategy that makes sense? I have 20 years left on the mortgage and I am retired. Jordan, what would you tell him?
A lot of people in that circumstance, something like 11 million people are exactly, they're paying on time, but they're underwater in their homes these days. Now, President Obama has come up with a new program called the Home Affordable Mortgage Program, or HAMP, which will allow people in exactly that circumstance to refinance at a lower rate, even if they've never paid late. They can do a refinance backed by FHA. About $50 billion from the TARP program is being put into this to allow people to refinance even if they're underwater. There's a website that can help people do that, which is youcanrefi.com, and they help you go through the whole process. This started about a year ago. Just recently, Obama has added new things to the program to allow many more people. See, in the past, you had to be late on a payment. Now you can even be on time and still get a refinance at a lower rate.
All right, David, the website is youcanrefi.com. Right,
Correct.
Jordan? All right,
Correct.
Great. Thank you for that. Paul of Cincinnati, Ohio asks, I went online to inquire about modifying my house loan, and I got a barrage of people who were willing to help. Of those people, some were lawyers. Do I need a lawyer to do a mortgage modification? What is the best way? What would you tell Paul, Jordan?
Well, he is correct. There's a lot of scamsters in this particular area. All the people that used to sell subprime loans are now doing mortgage modification. They figure they get them up front, now they'll get them on the back end, so we got to be careful about those. In many cases, lawyers are the best place to do it, because there's a contract. There's a mortgage as a contract, basically. And to renegotiate or modify that mortgage often requires a legal background. There's a website, a free website that can help people do this, which is modifymymortgage.com. It's actually run by former HUD officials who will refer you to a lawyer in your state to make sure you get a modification. Part of this HAMP program I mentioned before also involves modification. And again, they've made it easier for people to get modifications that was not available in the past. But it's kind of complicated, and having a lawyer is a good idea.
All right. So in this case, a lawyer is your friend. All right, now we have a question from Andrew of Los Angeles, California. He writes in saying, I am behind on my mortgage, and my current mortgage company says my only option is a short sale or to pay up the money I owe. They will proceed with foreclosure papers soon. I need your help to stop the foreclosure or at least stall the process. Oh, our heart goes out to Andrew.
Indeed.
here.
Well, this is happening to a lot of people. We had 3 million foreclosures last year, about 170,000 mortgage modifications. But the new program that President Obama just came out with says if you're in the middle of a mortgage modification process, they cannot foreclose on you. So you want to start that mortgage modification process and hopefully forestall the foreclosure. I mean, a modification is something that happens when you've got the income to pay a lower amount. If you have no income, you're not going to get a modification. But I would give the same website as before, modifymymortgage.com, and they're helping people prevent foreclosures using this HAMP program.
And what signifies the beginning of a mortgage modification? Just making the phone calls? Do you need some paperwork?
Well, there's a lot of paperwork involved, because what you have to do in effect is sell yourself to the mortgage and say, here's why I can pay a lower amount. I'm paying $1,200 now, I can afford $800, and here's my income, here's my expenses, and then say, okay, we believe you, we'll give you the $800. But you've got to make a case as to why you are going to qualify for mortgage modification. You know, last year, as I mentioned, there was about 170,000 modifications. There were about 800,000 temporary modifications,
right,
and about half of those so-called redefaulted. In other words, they got a lower payment and didn't make the lower payment, so the bank says, why should we give you a break when all these people aren't really following through on what they said they were going to do?
All right, good luck to Andrew. Start that modification process as soon as possible. Now, Amy of Wichita, Kansas asks, I am trying to refinance my home and include my home equity line of credit, so I only have one bill to pay. My home does not appraise enough to get the refinance. Can you help me?
Again, I mentioned before, you can refi.com, even if you're as much as 25% underwater. There's this FHA program that can indeed help you refinance your home and get a lower interest rate, consolidate it all. Now remember, in the first segment we talked about the mortgage equity acceleration strategy. That might work for her because the HELOC line is going to be at a much lower interest rate, about 3.5% today, as opposed to the traditional mortgage, which is going to be 5% or more. Again, the website for that is truthinequity.com. So that actually might work, is to have it consolidated in the HELOC instead of in the traditional mortgage, and save yourself a lot of money.
All right, Amy, that website, truthinequity.org.
.com. Right.
Okay, thanks, Jordan. Our last question comes from Tom of Atlanta, Georgia. He writes in saying, I am in a Chapter 13 after I lost my job. My foreclosure is in court right now, and I'm trying to see if they will do a modification. It has been 16 months since I've made a mortgage payment. Are there programs out there that could help me out?
The problem is he doesn't have income, and being unemployed, again, the modification is based on your ability to pay the lower amount. And if you have no income, they're not going to give you much of a break, and particularly he's had 16 months without payment. He's already had a pretty big break here. Sometimes getting foreclosed upon, walking away, is the best thing you can do. You just can't, if you don't have the income, you're not going to be able to support that house. So it's unfortunate, but this is why a lot of people are getting foreclosed upon these days because of unemployment. They do not have the income to keep a mortgage up. It's better to rent sometimes, Tanya, and in a case like him, it's probably better.
So maybe Tom should, if this works for him, allow the foreclosure to go forward and then work on the process of rebuilding his credit.
That's right. That's right. I mean, 16 months is a long time when you haven't paid. You're way, way behind at that point. You could try a short sale, which might be helpful, but he doesn't have the income to support a modification or a refinance.
Right. All right. Well, Tom, good luck to you. And Jordan, thank you very much for taking the time to answer our viewer questions.
Thanks very much.
And if you would like to submit a question, go to our website at abcnews.com, click on the Money page, and ask our team of personal finance experts your questions. We'll do our very best to answer them right here on Good Money.
ABC News Now. Good to know.